company, China's Yaming, and they will invest $50 million to set up a plant in China. I'm referring to Havells India. The Joint Managing Director, Anil Gupta, is with us to take us through this JV. Hi Anil, good to have you on our show. Can you give us more details about this JV? What exactly are you all planning to manufacture? What are you bringing to the table? What's the Chinese partner bringing to the table?
Well, as you know, Havells had acquired Sylvania globally in 2007, and we manufacture all kinds of lighting products like HID lamps, LEDs, CFLs, and lighting fixtures. This company called Shanghai Yaming Lighting Limited is based in Shanghai and is an 88-year-old company, very specialized in manufacturing such products. As you know that China is the lighting factory of the world, and we needed to have a good manufacturing base in China to support our global requirements. So we've already had R&D set up in China, but we wanted a manufacturing base. So we wanted to tie up with a company where we can provide our technology and use their manufacturing infrastructure and manufacturing expertise to manufacture products for the global markets, for the Chinese markets, and for the Indian markets.
Okay. Well, before I come to specific numbers about your timetable in China, for the past couple of years or maybe 18 months, the argument has been that local Chinese salaries are moving up, local Chinese inflation has moved up, the currency is not depreciated as much as the Indian currency. So Chinese margins actually have shrunk compared to India, though of course there could still be a gap considering the base with which China began. Just tell us about business. Is it still so much more lucrative to do business out of China than India?
Well, the aspect that we look at when we compare Chinese manufacturing is the cost arbitrage, and I think it's not just fair to look at the cost arbitrage only. What we are looking into is the access to technology, the access to technological manpower, the access to raw materials, and where we believe that China is ahead of certain other countries and other parts of the world. Both, if you really weigh the benefits of low-cost manufacturing, as well as the access to technological manpower and raw materials, China is a better option for us for these product categories that we are manufacturing as compared to India at this present moment. However, we do not rule out the possibility of manufacturing these products in India as well, because in India is a huge market, and I believe over a period of time, when these requirements for these kind of products will grow up in India, we might manufacture in India as well.
Getting down to the European business then, Anil, what's the update with Sylvania? You managed to improve your margins in the last quarter. Do you think that can be maintained? And also an update on the domestic front. We believe there's rising competition that's actually put some pressure on pricing. Is that argument right now?
Well, as you know, European business comprises about 70% of the Sylvania turnover, and with all this news about slowdown in Europe, we've turned around the business in Europe. In fact, while Sylvania was profitable last year as well, but Europe was loss-making. This year, Europe has turned around, and Europe has started making profits. Though we have not seen any sales growth in Europe this year, but our profitability has improved drastically. And I believe for the next year also, our aim would be similar, and we'll continue to expand our margins in Sylvania global business. As far as India is concerned, competition has increased in terms of raw material prices have gone up, but the investments that we made into the brand, as well as deepening our infrastructure and brand distribution within the country, we've been able to maintain our margins, and we continue to hope so in the future. This year, Havells in India will be growing at about almost more than 20%, and that's what we're looking for the next year as well.
Just to take that point further, investment into brands. Last quarter around, your margins actually surprised the street because you invested lower in your brands. The advertising was much lower. Do you expect to maintain the advertising spend at the Q2 level, and the investment into brands is now peaked off, or do you think it could be revived again?
Well, advertising continues to happen in bursts and lows, and so second quarter was a low in terms of advertising. But this year again we have taken up certain cricket series, and now we are the co-sponsor for India Australia series as well. So brand would need continuous investment, and we are continually doing that. Some quarter to quarter there could be differences, but overall our budget on brand spending is constant.
Okay. Well, I just want a few more details about the Chinese effort. You said you already have an R&D outpost over there. What is exactly the generation of income, if any, from that point, from that place? And now, how should a Havells investor look at revenues flowing out of China? You've put in how many million? Out of that $50 million, is all that your money? How much are you putting in? And what will be the returns to the Havells investor?
Well, we look at China from 3 points of view. One as a sourcing base, the other as a R&D and a manufacturing base, and third as a market base. We have been sourcing from China for the last many years now, but over the last 4 years we started investing into a setup for R&D. We have over 150 engineers who are constantly developing new products in conjunction with our Indian R&D center and European R&D center. And so all these three areas work together on developing new products. But this is now being expanded to have a manufacturing base as well. The third is the domestic market itself, where we launched Sylvania brand last year. And this year we'll be doing close to about $5 to $6 million there. But very soon we'll be ramping it up. As far as the joint venture is concerned, this $50 million is the total investment size for the joint venture. 50% of it will be invested from Havells India, the rest will be coming from Shanghai Yaming Limited. And in the next 3 years or so, 2 to 3 years, we hope to ramp the revenues up to almost $100 million coming out of this joint venture.
Okay, so accordingly, what kind of percentage increase in revenues can we assume in the next 2 years for Havells?
Well, the domestic market, we hope in the next 2 years would continue to grow at a pace between 15 to 20%. Globally, apart from China, we will definitely see a growth of 7 to 8%, which has happened this year. And overall, if we put all together these new initiatives, we definitely want to expand and hope to expand at least at the rate of 15% globally.
Among all the segments that you operate in, Anil, the cables and the lighting division is the one that's outperformed in terms of revenue growth. We've had very decent growth there, but sometimes the argument also veers to the fact that the profitability growth in that segment may not be, may not match the kind of revenue growth we've seen. Do you think that argument holds? And also, what's your outlook for each of the segments if you were to split it up?
As far as lighting is concerned, it is definitely going to hold profitability. In fact, we have expanded profitability in lighting by quite a decent margin this year. Cables and wires, 50% of the cables and wires business is a commodity business. The rest is domestic wires, where we can, get the returns to the brand. So there, the margins would always be under pressure. But overall, given the volumes of this business, which will be close to about 1,600 crores in cables and wires this year, it is definitely a profitable business. And we are looking at expansion in margins this quarter, where raw material prices have also gone up, but we have been able to effectively manage our costs, and pricing we have been able to manage. But in the coming quarters, we hope to see expansion in margins in cables and wires as well.
So what would those margins be? Just to get a percentage out of you, 12, 13 was something you were doing, right?
In cables and wires, our margins were 8 to 9%. We see that going up to 12 to 13%.
And overall, your margins were?
Overall, our margins were around 11%. This year, we are looking at maintaining at about 11.5%.
All right, we'll leave it at that. Anil Gupta, thank you very much for joining us on what should be a very important day for you, announcing a JV with a Chinese company, Shanghai Yaming, and the expectation is that within a couple of years, that plant will be adding about $100 million in terms of revenues. That's an interesting story, and important, because we are almost expansion stories have dropped to a trickle. So it's always good to hear.